Will we see another huge bear market sell-off after the current run, or are we heading towards the mystical super cycle? In today's video, we break it all down. Let's jump in. Welcome back to another video. My name is Ian Major. I'm an entrepreneur, Bitcoin pleb, and all-around raging capitalist. And it's an interesting question that several of you have posed, some sort of variant that boils down to what are we going to see after this current bull run? Are we going to see a 80 to 90% drawdown similar to what we've seen in prior cycles? Is it going to be more muted, or are we going to just break away into this kind of super cycle off into the sunset? It's a good question. For those of you who have been watching this channel for any period of time, you know that I typically don't go into near-term price predictions and anything like that, mostly because I ultimately think trying to time the market is a fool's errand. As we've seen, many times, people get wrecked and wrecked and wrecked again, and then they feel like they have to take leverage to make up for getting wrecked, and then they get wrecked even harder. It is a horrible, horrible hamster wheel to get in. You don't want to do that. You just want to DCA, dollar cost average, hodl forever. And if you can literally just do that, you're going to make it, my friend. But I still think there's value in critically analyzing this type of question because it forces you to think about the ecosystem and this sort of magic internet money more deeply than you otherwise would. And so I think there's a lot of learnings that can come out of this that make you a better hodler, even if it's not going to ultimately change your behavior. And so in today's video, I'm going to go through some of the factors that I think have a tendency to perpetuate and continue the cycle. And I'm going to go into what factors could potentially change that. And so stay tuned. You won't want to miss a thing, including the conclusion we ultimately reach at the end. But for those returning to the channel, welcome back, my friends and brethren. As always, it is nothing short than an absolute pleasure to have you. And for those new to the channel, I welcome you, my friends, as well. I know there are many of you. In fact, about 80% of you currently watching right this moment are not currently subscribed. And so if you like this content, I invite you to consider subscribing and join us in our merry gang in cyberspace. I cover all manner of Bitcoin-related content, including news and analysis such as this, but also wallet tutorials, DeFi on Bitcoin, Lightning Network, running your own node, and more. You want it, I cover it. But with all that out of the way, let's start to jump in and pick apart this question. So let's first start with some of the factors that I think would perpetuate or continue the cycle as we've seen. And again, as a matter of historical context, I'll just throw up this kind of long-term price chart, and you can see what I mean in terms of these kind of massive drawdowns and blow-off tops that we've seen following kind of each cycle. And we'll talk about some of the underlying factors that have, at least to date, caused these ups and downs. And to be clear, in the context of the current cycle, I think we are going way, 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 way higher from where we are right now. So just a few days ago, price was just about kissing 67K. We're now back down towards 60. But it seems like 60 is forming this support. Who knows whether that will hold or not, but even if it goes lower, I think that's only going to launch us subsequently higher. And I think there's a pretty good argument that this current cycle is going to be elongated and extend potentially even well into 2022, talking January, February, maybe even March. This is looking structurally a lot more like the 2013 cycle where you had the kind of double peak, where you had the big trashing of the market in between, and this period of extended reaccumulation versus 2017 where you just had this huge kind of singular parabolic run up and then the massive blow off top. So it remains to be seen. Again, like, take all of this with a grain of salt. Who really knows? I don't know. No one knows. But that is at least my base case for this current cycle. And so the question is like, well, what happens after that? And so I think there are a number of factors that could perpetuate seeing a big drawdown subsequent to that over the rest of 2022 and 2023 as we then approach the new halving cycle in 2024. And one of those factors is just sort of psychological in nature, and it's the precedent that we've seen historically. It's this kind of self-fulfilling prophecy that because we've seen such big drawdowns in the past, many market participants will anticipate that happening again. Will also, of course, naturally be profit taking in any market such as this. There's not just hodlers out there, such as many of the folks watching this channel. Some of you may be traders, and I wish you well in those endeavors. I really, really do. But I think most of you are doing yourselves a disservice. And furthermore, think of where we are, at 60K right now. And I mean, retail's like not even anywhere to be found. I think over the last few days, we saw a slight reemergence of retail, right, who always comes out when we're approaching or, exceeding prior all-time highs. You're going to pick up a bunch of lettuce hands who are new to the market, who are going to come in, who are going to buy at 80K, 90K, 100K, and, who are probably going to sell at those levels when we come back down, if we come back down. But I personally think the single biggest factor, by probably quite some margin as to why we might see the continuation of cycles, is really the underlying reason that we've seen the cycles in the past in the first place. And it comes down to Bitcoin miners. These are operators who, for a living, convert electricity into Bitcoin. And so to cover their fiat expenses, such as electricity, the facilities, depending on kind of how big they are as an operation, that is typically the biggest force and selling pressure, at least outside of some of these very speculative kind of events. And we can generally see that in this graph. This is a miner direct selling index. It's basically the black line is price. The red line is basically an index showing how much miners are sending their earnings into exchanges. And so you can see this marries up pretty nicely. When you have a spike in miners sending, and again, this is not a perfect measure by any means. There's a lot of sort of noise that can even impact this kind of red line here that we won't get into in this video, but it is at least indicative, as you can see, right? You tend to have peaks in the miner flows to exchanges, aligning to periods of selling and periods of subsequent price declines. And relatedly, there is a way to think about this through the lens of the miner's business and sort of the business cycle. This classic from Preston is a really good way to think about it. And so he's basically mapping out, part of the prior cycle. And I actually think his ordering of 1 through 6 here on the left is a little bit, I think he could have reordered it to make it even crisper. And so here is my voiceover attempt to do that. And so basically what happens is you have a halving event, right? This is pre-programmed in roughly every 4 years. New issuance of Bitcoin as part of the block subsidy is cut in half. And so the last time that happened was May 2020. And so we would expect the next one to be roughly in 4 years from then. And so what happens is as you cross over that halving event, you ultimately have inefficient miners who capitulate, meaning they just leave the market entirely. They are no longer competitive, given perhaps they're running, older versions of hardware and ASICs. You basically have a portion of the mining community that is no longer profitable and competitive. And so they essentially, turn themselves off. This in turn tends to remove some of the selling pressure. So leading up to that, even maybe they were, not as competitive as they were at the very beginning of the cycle. And so they might have been, selling a bit more than they otherwise would from their treasury onto the market just to kind of cover expenses and keep it going for a little bit longer. But either way, you have the halving event, inefficient miners capitulate, and now all of a sudden you remove some of the selling pressure that was there previously. And along with what is probably going to be a dip in hash rate, you have the difficulty adjustment that makes it more profitable for the competitive miners that are left standing. And if some of the prior selling pressure has been removed, then they're also probably starting to see a pickup in price as well. So profitability becomes very good for the existing miners. And in that positive sort of part of the business cycle, some of those miners are now they're long-term thinkers, right? They're going to say, how can we invest in the business in order to prepare ourselves for the next cycle. And so maybe they go and invest in upgrading their hardware to some of the latest machines, et cetera, et cetera. Meanwhile, prices continuing to creep up. That's when speculators and traders come in and they see this thing going up and they pile in. And then we ultimately get the kind of parabolic ramp up. And the escalating price brings more hash rate onto the network. And gradually you kind of get to the point where it becomes harder and harder to be competitive. And once again, you have the kind of less competitive miners that are now going to have to sell. And ultimately that can help trigger some of the big blow off tops. Once you start having downward pressure on price, then all of a sudden, speculators and traders kind of dump their bags, and that's how we can get these big sort of run-ups and blow off tops. And so this is like very structural. I mean, this is kind of stitched into the very fabric of how Bitcoin works as a system. And so I think it's going to take something pretty extraordinary to counteract this. But that's exactly where we're going next. So in direct response to the biggest factor, I believe, that we just covered, which is kind of the miner's P&L and how that gets managed across different halving cycles, you might then say, well, if there was only a way that miners didn't have to sell their Bitcoin, and if they could just continue hodling but somehow raise fiat funds to cover their expenses, that would tackle that factor. And you're exactly right. And so we're seeing this very interesting migration of hash rate that plunged due to the China bans in the summer to places like the US. Now, I'll be the first to say that concentrating from one place into another, no matter where that other place is, like that is not a good thing. We don't want to see, hash rate get as concentrated even in a place like the US as it was in China. And so that's a quick sidebar. But it's pretty clear to me at this point that there's going to be a number of states, including Texas, probably Wyoming, and there's certainly others who are going to be advocates for the Bitcoin mining industry. And so because of this actual out and out support, I think you're going to see more and more financial support to enable miners to borrow fiat against their Bitcoin as collateral. And so this means they no longer have to sell their Bitcoin outright, but rather can borrow against it, and provided that the price of Bitcoin continues to appreciate over a long period of time, they can just kind of roll that debt over into perpetuity. And so to the extent we start to see this on a broad scale, that's going to get very, very interesting. And indeed, there's this nice example from Argo. So Argo is a Bitcoin mining firm, and they secured, I think this was back in June, back in the summer, but they secured a $20 million Bitcoin-backed loan to expand their operations. So it's exactly what we were just covering in that cycle, where competitive miners are going to kind of upgrade or expand their operations during times like these. And let's just read some of the text. Bitcoin mining firm Argo Blockchain has announced that it secured a $20 million loan agreement with financial services company Galaxy Digital. And so Galaxy Digital is very immersed in the sort of broader, crypto asset space, digital asset space. And so this is really interesting, right? You are going to see more and more of this. Miners, if they can help it, wouldn't want to sell their Bitcoin. And so I think the combination of hash rate moving into jurisdictions such as Texas and others that are more favorable and open, right? In China, it was kind of like, yeah, we know this is happening, but, we're not going to clamp down just yet. We're going to kind of let it happen, but we're not going to support it. We're certainly not going to support it. The second that you now have hash rate moving to more favorable jurisdictions where it actually is supported, it's a win-win for everyone. And so this could be a very interesting dynamic that I think will ultimately play into a supercycle. The question is whether it does that sufficiently quickly in the context of this current cycle. So that's one huge factor that could kind of break through from what we've seen in the past, i.e. the removal of what has been the main historical driver for selling pressure. That would be a huge one. The other dimension, the other way this could work, of course, is a huge influx of new demand and new money. And make no mistake, I think that ultimately will happen. The question is, does it happen fast enough in the context of this current cycle? So you've got, nation, state, and institution level game theory that is just going to escalate and escalate and escalate. I mean, every major bank in the U.S. now, a couple years ago said, Bitcoin is never going to be a thing. It's horrible. It's stupid. People who own it are stupid. And now they're literally turning around and offering their clients services to invest in and custody Bitcoin and all this sort of stuff. So you're going to continue to see that roll out. And I'm going to throw this chart up if I can find it from Will Clemente, but he posted a fascinating view that sort of makes the case that like the hodler, like the long-term hodler is just so high conviction now. But basically what it shows is just this kind of long-term breakout in long-term hodling behavior. And I think there's some deep psychology that goes with this. Basically, when enough people have seen enough dips only to see Bitcoin inexorably rise yet again to yet another high, like, people aren't stupid. Eventually they're going to realize that, all the crap I've been told by the media, all the crap I've been told by regulators, all the crap I've been told by all these institutions that are representatives of the legacy system are lies. This is all a lie. Like, this thing is real. They can't kill it. It's not dying. Why is it not dying? People have said it's going to die. People have said it has died. And yet here we are. And so once enough people experience this, like, you kind of have to get burned, or you kind of have to feel the pain of, a 50% drawdown or an 80% draw. Like, you have to feel that. And then once you get to the other side and you see that, like, it was just driven by X and this and that, and the fundamentals are not just intact, they've even improved. Once enough people experience that, you end up with an even more cold-blooded group of hodlers that are not going to relinquish their sats for anything. And so, in recap, I think the combination of these factors, a more cold-blooded hodler, nation and institution level adoption, i.e. new money coming in, and the potential for much more expanded services that would enable miners to raise fiat with their Bitcoin against their Bitcoin as collateral, all of this could easily combine to, and I think will combine, to break us into the super cycle. Now, net, where do I fall? I think there will still be a bear market. I don't think it's going to be an 80 to 90% drawdown like we've seen in the past, but I think 40, 50% is easily in the cards, because we're just not going to see any of these factors sort of play out rapidly enough. I think this is my hypothesis. I would love to be proved wrong, but this is my base case, right? And it sets us up for the super cycle to kind of be, only a few short years away once we see the next halving event in 2024. So that's where I stand with all this. Let's go ahead now and wrap this video up. All right, my friends, there you have it. So we covered some of the different factors that could perpetuate or change the historical cycles that we've seen with Bitcoin. But I don't think any of these factors are going to materialize quick enough to sort of prevent us from seeing a fairly sizable bear market. And by fairly sizable, 40, 50%, like, come on, like, that's not that bad. And it's a great thing for us hodlers because we can pick up some sats for a discount. But that's my base case. I am curious to hear what you think. Let me know your thoughts in the comments down below. But for now, we're going to go ahead and leave this video here. I hope you at least found this valuable and useful. If you did, you already know what to do. Give this video a like. Let me know your thoughts, reactions, and questions in the comments down below. If there are other videos you'd like to see in the future, I really do take that into account when making the schedule for the channel. But for now, we'll go ahead and leave this here. As a reminder, my friends, every single sat counts. And until next time, I'll see you then.